Hello to all the attendees today, 24th of April 2020. I'm Reem. I'm here from CFI. I am actually in CFI Dubai branch, and I would like to welcome each and every one of you who joined us today in this live webinar. Just before I start, good afternoon, Hassan. Just before I start, I want to make sure that the sound is loud and clear. Can you please confirm to me that the sound is clear? Hello, Karen. Okay, perfect. Okay, great. So anytime you experience difficulty in the sound, please just let me know in the box, or you guys can just restart the session because sometimes it tends to be a bit crowded. So you just restart the session and it will be fine. Okay, great. So thank you guys for joining. This session today is going to be basically to understand the basics of trading. So again, I'm the research analyst at CFI here in Dubai branch. Of course, we are present around the world. Later, I will cover more in details about CFI and where are we located and what are the services that we provide. Just to start with, what are the advantages of the Forex market? I'm sure every one of you is here for a reason. You guys are here to understand the basics of trading in order to enter the market as a step for a personal investment. That's the main goal. So my presentation today will cover three main sections. First of all, we're going to understand the basics of online trading, the basics of the Forex market, commodities, stocks, and so forth. This is the first part. The second part is going to be an introduction, just a brief introduction about the platform that we provide in order for you to trade in that foreign market. And the third part will be a brief about CFI. So to be honest, the first and the second and the third part are as important together. And if you guys were with me today and everything was fine, I hope you guys get also engaged with me, ask questions if you want along the way. So this way we can form our second presentation or our webinar where it's going to be a bit more advanced. This one is going to be basics. Okay, so we go step by step along the way. Once we get the basics of trading, we can then build up with more advanced sessions. Perfect, Richard. Okay, let's go on. So now at first we're going to understand the basics of trading. Basically, when you want to trade in the online market, you have to know that the company you're dealing with is regulated. This is the first thing. I'm not going to talk a lot about our company because I mean, you guys can always research and go online and you know all the details, and that's the reason why I'm here. So I'm going to go over and show you the advantages of trading in this market. Of course, it's definitely, you need to check that the firm is regulated. You need to know that is trading good for me? Is this what I'm looking for? As you can see, like what are my goals? Do I want to make a short-term investment? Do I want to make a profit? Do I want to capitalize on a long-term investment, profits on long-term, on some stocks, on some contracts? So what are my goals? You need to define your goals before you enter in that market. And the second thing you need to know is the benefits of trading. Of course, everyone wants to go and to win at the end, right? So what are the benefits of trading? Right now, what I want to do today is not actually for you to win or lose. I want you to understand what are you buying and selling? What are you in for? Understand. Basically, I want to try and give you an education more before we start buying and selling. So that's the first as an intro. Now, to jump across, I want to tell you about the advantages of online trading. First of all, as we all know, I hope everyone is safe and sound. We are in quarantine times at the moment where we're home. So one of the advantages of trading online is that you can be anywhere, anytime, home, not home. You just need a computer, internet connection, and there you go. You can access the online market. So that's one thing that's very important for you to know. You can access this anywhere, anytime. And this is a good time, like the liquidity, the high liquidity that we see in the market. This is when we can grab the opportunity and try to capitalize on it. I'm personally lucky to be part of what's going on now around the world. because you can see the volatility in the market where you can try to grab opportunities. Later on, I will show you how to take advantages of those opportunities. Another advantage of trading online, as I said, it's an online market. The online market opens 24 hours a day. Reason being is, if you can imagine the map in your head, like the parts in the map down there, Austria, New Zealand, they open after midnight, and then you go for Asia, like Japanese, China, Japan, and then you start going more along the map where you can see that we get to UK in the morning, and then the whole European market starts opening up, and then the US market afternoon, if we're talking Middle Eastern time. So as you can see, the stock market opens 24 hours, 5 days a week. This is another advantage where you can trade anytime during the day. Of course, on weekends, Saturdays and Sundays, the market closed. One more thing, there is a very high liquidity in this online market. I'm talking about liquidity of more than 5 trillion volume per day. That means if you want to compare the trading online in the Forex, commodities, CFDs on stocks, there are more than 5 trillion trades volume-wise. If you want to compare it, just to get the hang of it, compare it to New York Stock Exchange or Tokyo Stock Exchange. These are one of the two big stock markets around the world. Trading on these stock markets is probably $1 billion, $2 billion. That's it. We're talking about 5 trillion. What does that mean? How does that reflect for me as an investor? It means that anytime I enter the market to buy or to sell, I have someone in front of me who is selling or buying. So I don't have to keep waiting for a buyer if I'm selling, and I don't have to keep waiting for a seller if I'm buying. So this market is very volatile, is high liquid, it moves fast, any time of the day, five days a week. Unlike the stocks, let's say if you're holding a stock in the European market, any stock, or even in the US market like Facebook or any other stock, you might not. First of all, you need to wait for the market to open, because stocks, they operate when the market of the US market, when the US market is open. So you cannot trade any time of the day. You have to wait for the session to open. This is one. And two, you cannot always find one who's selling or buying. Let's say Facebook stocks are going up now, and all of a sudden everyone is buying. So if you really want to sell your stock, or if you really want to buy, you cannot really make it as fast as execution as you want, because a lot of people are buying. You might not find sellers out there. So this is why the leverage, the volatility or the liquidity in this market will be much less than the liquidity in the online Forex trading markets and commodities, of course. Now, I will explain more what is Forex in just a second. Also, this market has no intermediary. It's an OTC market, it's an over-the-counter market, so you don't have to wait for an approval from a bank or an authority to do this trade. There's no intermediary. This also makes it fast in execution when you want to execute. Another advantage of trading online is that you can actually take advantage of the market going up or the market going down. A lot of people ask me this question, Reem, how can I take advantage of how can I sell when I don't have something in my hand? This is what we will be talking in details in a bit, going forward a bit. So at the moment, I know you guys are questioning what are we talking about. I just want you to see, before we go in, the advantages of trading online, especially in the times that we're passing through right now. If you guys have any questions along the way, please feel free to type it in, and I'll just be happy to reply back. Another advantage, of course, is that you can actually download a demo account. This demo account reflects the exact real account on the market. You can actually see the real prices of gold, see the real prices of oil, of the WTI, of the Brent, of crude oil, the US crude oil. You can see the prices of the euro, all the currency exchanges live this second. The price is live on the demo account as well. So you can actually translate it to a real account while you're on your demo. Through the day, so Hassan is asking me, please Reem, we need more reports through the day, not only morning ones. Okay, so you mean what we can provide, Hassan, as reports for you guys for technical analysis? Because usually we provide those analysis twice a day. I will also talk about this later in depth. We have one in the morning and one afternoon. One when the European market opens and one when the US market opens. So UK time, I'll just relate it to the Middle Eastern time. That's around 9 or 10 a.m. I think by your time it will still be 6 or 7 a.m. You receive the morning report, and then by around 2, so by around 11 or 12 UK time, you guys receive the noon technical analysis. Okay, where you can place your trades based on this analysis. Maybe later on I can show you more what am I exactly talking about and how to place orders on this report. Although Hassan, I wanted to make this as our second training session. This training session is only basics. We will not execute, but if you guys insist, we can definitely show more execution. You're welcome, sure. So I will move on just after we briefly talked about the advantages of trading online. I will move on at the moment to talk about the Forex markets. I said you heard this word a lot for now. So basically, Forex comes from the word the foreign exchange market. As you can see, this is where the Forex comes from. When you say Forex, you mean currencies. When you say currencies, you always think about pairs. Currencies, they operate in pairs, okay? So, and when you say operating in pairs, we are talking about buyers and sellers, okay? So pairs, you're buying the one pair, you're buying one unit, you're selling the opposite one. So that's why they always come in pair. Okay, so that's what you need to know. And I'll talk about this a little bit later. And of course, coming back to my first point, that it's high, very high in volume trading on a daily basis with 5 trillion, as you can see. And also, as I said, it opens 24 hours, 5 days a week. And of course, how like I will talk a little bit later, this advantage of this market is that it uses something called leverage. Team, listen, I just want to tell you something. We will learn key terms in trading online. There are not really like 5 or 6 terms that I want you to write down, because these are what you actually need. These are the language, if you want, of online trading, of trading in general. So one of those words or key terms is leverage. Okay, so we will explain this later in details, but this is the first term you need to know in the financial market. So the term leverage, okay? So keep this on the side. We'll come to this later. I'll go on with defining what the Forex market is. As I said, it's a foreign exchange market where you deal with currencies and they always come in pair. You buy one, you sell the one that's in opposing of this pair, or the opposite. You sell the first, you buy the other. So it always comes in pairs. And the second thing that's important about the Forex market is that you have majors and you have minors. When I say majors, it means we're talking about the US dollar in this pair, okay? So anytime you think that a pair, or you see that a pair has a US dollar in it, as you can see in this example, Euro US, Pound US, US dollar Japanese yen, US dollar Swiss franc, US dollar Canadian, Australian dollar, US dollar, New Zealand, the dollar New Zealand, and the US dollar. These are called the major pairs, okay? Because, you tell me why? Because there is a dollar in this pair, okay? So let me tell you guys, the dollar, the dollar currency probably is not the strongest in the world. However, the economy, the US economy controls. The US economy is considered the strong economy. That's why when the pair has a dollar in it, we consider it as a major currency pair, okay? Now, what are the minor currency pairs in this example? Anything that doesn't have the dollar in it, obviously. So these are called minors or crosses. So you get to see like Euro Japanese, Euro Swiss franc, Japanese yen. So with the pound. So anything that doesn't have the dollar in it is called a minor or a crosses. Anything with a dollar is called a major currency. Okay? One more tip here. When you see the currency, as you can see, there is one on the left and then another on the right. So the one on the left is usually the stronger currency, or the pair. In this pair, when you buy or sell, you're buying the one on the left. Okay? So guys, stop me if you have any question, or if I'm going a bit fast or anything, just let me know. Pause and let me know, okay? I'll go on. So basically what I said here is that we have major pairs and minor pairs. One more advantage in trading with major currency pairs that involves the US dollar in them is that 70 to 80% of the global, remember a minute ago I told you the volume of trading is 5 trillion in the Forex market. When I say Forex, I don't only mean currencies. I'll tell you later on what else do I mean, but as a start, it's mainly currencies. So 5 trillion is the daily volume, okay? For you guys to be clear. 70% of this 5 trillion is in the majors. So is basically in the currency pair that has the dollar in it. This will also include gold and oil. I will talk about this in a minute. The reason being, gold is considered a commodity. Oil is also considered a commodity, and these are pegged to dollars as well. So when you say oil, it's pegged to dollars. When you say gold, it's pegged to dollars. So it's the gold. If you're buying gold, it means if you can say, you can put it in your head, you're selling the dollar. Okay, so these are very important points. If you guys have any question, please stop me and just ask. Okay, Muhammad. Yeah, oh my God, are you surprised? Yeah, so basically that's how volatile it is when it comes to major currencies. That's how strong the US dollar is. Okay? So basically this is the majors and minors. I'll move on, team. I also talked about this before, but I will show you in a clearer table here that the Forex market, as I said, it opens 24 hours a day. As you can see, you guys can do the math with the timings because of Dubai, UK, it's just a bit different. But as you can see, by when the Asian market, or when Australia, New Zealand, these kind of markets are open, everything else is closed. And then before the closure of New Zealand and Australia, their Asian market starts opening up, like Tokyo, like China. And then along the day at 6 or 7 a.m. Dubai time, that's probably after midnight, 3 a.m. UK time, the Asian market closes. And then you start like you probably have a couple of hours of break before you initiate with the European market. So Hassan, what you're saying, my wife Emma sat beside me saying, hi Reem, and wants to learn more about Forex. Yeah, please Emma, if you can just open the session and join us. Yeah, would love to have you guys, and I just want to give some information out there, and it's more of a, I want your engagement. I want you guys to ask me, because I want to know what you want to know exactly, but I will give whatever I have. And please keep in mind that it's just the basics, okay? Because we need to learn the basics to move on. So as I said, the market opens 24 hours a day. If you guys want to, why is there a main trading session? Perfect. That's a very, very smart question, Hassam, right? Hassam, yeah. So let me tell you why there is a main trading session. This means, because you know, a second ago I said that you have the majors that contains the dollar in them, and they represent 7 or 8 major pairs that the dollar is in them, and they have a trading volume of 60 to 70 to 80% of that 5 trillion we just spoke about. The main trading sessions lies when the European and the US market is open. That's the main trading session. That's when you have a lot of volatility in the market. So if I want to talk Dubai time, that would be between 5 p.m. and probably 8 p.m. So that would be your time. Probably it would be 1 to probably 5 or 6. This is the time when the market has a main trading session. The market is volatile because the US dollar is actually, the American market is open, and the European market is about to close. It's still opening, but it's about to close. So this is the main trading session. It means high volatility, prices move super fast, and sometimes you cannot catch the trade. Things happen probably in half an hour. If news come up, it can happen in half an hour. That's why I always advise beginners to start trading not in that peak time. Although it's up to you, it's actually, everything is what you feel is best to do, but I prefer that you guys trade when the market is less volatile. At this time, it will be the movement will be so heavy. But sometimes at this movement we can grab an opportunity and make more profits, but we can also make more losses in this main trading session. So when the European and the US market collides, this is the main trading session where you have high volatility in the market. And mind you, every day when the US market opens, or when the European market opens, or when the Australian, when any session starts, there is a bunch of news released in that country or in that region. Like the US, when it starts trading, it has certain indicators that are issued at, let's say, it opens here at 5:30. I think it opens at 1:30 your time. There are some major events that are on the agenda every single day, and they actually move the market. If you want to think fundamentally, I will tell you later what I mean about fundamentally, because when you talk about the market, you have many factors that affect your decisions of buying and selling. So once you know the session is starting and you see this volatility, you can always go back to that agenda to see what are the main indicators that are going to be issued today. Might be an interest rate in the US, might be employment numbers, might be industrial factors, might be the growth. These are very high. We will talk about this in details in another session, team. Maybe we will do more than one session per week. We can specify fundamental session training where we talk about the major indicators and how they affect the trading. Where can we see these indicators? CFI usually provides you with an agenda, and we have groups where we send daily what is the actual indicator that's gonna, not, if I can say, yeah, you can say economic indicator that affects the market. We usually send a small agenda in the morning to tell you what is of high importance that affects the market. Okay, so please, Danny, if you want, you can just leave your email and I'll make sure to send you email later on to just tell you more about how you can be added to how you can be added to our WhatsApp group or emails where you can receive the daily indicator in a calendar. Okay, so this can be another session for us, team, fundamentals and how they affect the markets. I'll move on after this, when we talked about the major currencies, the trading hours. Let's talk about more interesting topic. Okay, so at the moment, I know that online trading is beneficial for me. I identified that I'm there to calculate my profits and losses. I'm there for a side investment. I'm there to learn more. I'm there because I have a portfolio and I want to diversify my portfolio. I have stocks. I want to buy currencies. I want to buy gold. So I know the reason why I'm there, and I know the reason why I pick certain brokerage firm. Okay, and I know the currencies at the moment, they trade in pairs. Now, what is a CFD? Just a step forward, a CFD, because when you say contract for difference, at the end of the day, you have spot prices and you have future prices. So when you say a contract of difference, you're talking here about a contract where you are buying or selling at the moment and you're going to close it on a future date. Okay? More details about the agenda. Sure, Firas, I will send you more details about the agenda, and I will add you to the group later on when we send our email. When I send you an email, we will add you to the group where you can be receiving the agenda on a daily basis. Okay? So basically, when you want to trade in CFDs, as I said before, you're welcome, Firas, you have a buyer and a seller. Okay, so when you want to buy, you have someone in front of you who's going to be selling. So also you deal directly with, in contracts of difference, you deal directly with your broker. It's an over-the-counter market. You don't need to go to the bank. You don't need to go to an intermediary. You just have your broker, and the trades are automatically straight through, or STP. They come from the US provider directly to your platform without any delays. This is the main advantage of trading in CFDs. Okay, so it's an over-the-counter trading. Of course, you guys need to know that because you are trading in this market, there is high risk as well involved, because there is also high return. We will talk more about high risk and high return when we talk about the leverage products. Okay, so when you want to trade in In the Forex market, you're trading CFDs, okay? So you're trading contracts for different, the meaning is you're buying or selling, and you're buying and selling the actual contract. However, your main goal is to take advantage of the price movement. So when you buy a contract of euro, later on I will tell you what a contract is. When you buy a contract of euro, you're going long. This is another term in trading, long. Long is buying, short is selling, okay? So leverage, keep that in mind. I will go back to this. And you have long and short. If you're buying, you go long. So if I want to buy, I'm anticipating that the euro will go up. If I'm buying the euro, I want it to go up so later on I can close my deal and sell it to make some profit, right? So in this case, if I'm buying the euro, I want the price to go up. So my main advantage is the change or the movement of the price up from, let's say, we'll talk about this in a minute. Let's say it's going up from 1 to 2. So I close it at 2 and I make that $1 difference as a profit, okay? If I'm selling, that's another advantage that we talked about previously. If I'm selling in the online trading, if I anticipate that the euro is going to go down, I sell one contract of euro because I think that the euro will go from 1 to 0.5, let's say, just giving a rough example, okay? So I can make the profit because the market is moving in an opposite direction. So this is another advantage of online trading. I'm just recalling what we said and how it works in our advantage now. We can take advantage of the market moving upward or downward, okay? And it always involves risk in it. Also, I'll talk about this. Now, we talked about the currency pairs. Team, if I have some time, I will talk also about gold and oil later, but I want you to understand currencies because this is the basics. Everything else is almost similar. The difference is a bit in calculating how your profit and loss, that's it, that's all, the calculations of profit and loss. But basically the concept is all the same. So I'm going to be stressing more currencies and giving examples on that as much as I can so that you grasp the idea, and maybe in different sessions or if I have some time we can talk more about gold and oil, okay? So back to the currencies. Currencies, they do work in pairs as I've just explained. Hello, can you guys hear me now? Okay, perfect. Sorry, just a little bit of connection problem. Okay, perfect, perfect. Let me go on then. Okay, so back to currencies. It might happen. I'll just restart in a second and I'll be back. Okay? Okay, perfect, Fadi. Thank you. Okay, great, Fernand. Let's continue. So currencies, they do work in pairs as I have said. Okay, as you can see, let me grab a pen. Okay, pointer, text. Okay, fine. Draw. So as you can see, as I have mentioned, that currencies, they work in pairs. So the euro against the dollar. This is the example I'm gonna have now. The euro, or the currency that's located on the left, is called the base currency or the major currency. While the currency that's located on the right, that's the counter currency or quote currency. Okay? So the major, the base, and then the counter or the quote currency. So when you want to buy or sell a currency pair, you're buying the base currency or you're selling the base currency against the counter currency. So in this example, if I want to buy a euro, I sell the dollar. And vice versa. If I want to sell the euro, then I'm buying the dollar. Okay? This is what you need to know, guys. So the base currency is the major currency that's listed on the left, and then the counter currency instead of USD. Of course, you can have the base currency. Why do some currencies come in a base currency instead? if the USD, Wael, I thought I understood, but if you can just explain a bit. Why do some currencies come? Yeah, as I was saying, if the euro at the moment is on the left, this means the euro is stronger than the dollar. If you want to read this pair, you read it as 1 point, let's say 0.1 something. So because the euro in this pair, the euro is stronger than the dollar. That's why you have the euro on the left and the dollar on the right. Okay? If the dollar is on the left, it means the dollar is stronger in this pair. You got me, Wael? Let me know if this answers your question. So I'll go on. Okay, perfect. So I'll go on. Basically, the base currency, as I said, the euro on the side. This is the currency that's stronger, and this is the currency that I'm buying or selling. Okay? At the moment, if I want to buy stronger. Yes, stronger. It means you need to pay more in dollars to get 1 euro. Okay? You need to pay when you go to the exchange. If you have $1,000 in your pocket and you're going to the exchange because tomorrow you're going to I don't know, you guys are in UK. If you're going to, let's say, Paris, you want euros. Yeah, so if you have $1,000 in your pocket and you want to exchange it for euros, you need to pay, if you want exactly 1,000, if you want exactly 1,000 euros, you need to give the exchange house, let's say, $1,100 to get that 1,000 euros. So you'll be paying more dollars to get the exchange in euros. Okay, so that's why you have the euro that's stronger on the left, because you need to pay more to get. Yes, yes, exactly. The Australian is weaker. Should be the stronger. Yes, absolutely, Fernando. Usually the base currency is stronger. That's like known from hundreds of years ago. Okay, the base currency is the one that's stronger. Sometimes you might find it. You might. So why is it on the left? Which one? Yeah, you mean the Australian? No, let me tell you why. Because conventionally, very good question, Hassam. Conventionally, conventionally, the Australian dollar was stronger than the US dollar. We're talking hundreds of years ago. So they did not change this convention. It was, the convention was there, was set as Australian dollar. So they did not change it back then, and they will not change it now. Just like sometimes they ask me, why is the gold called XAU and not gold? Because previously, that's the change, then they change frequently. Yeah, exactly. Then they will have to change frequently if they do it one time. So they kept it as a convention, Australian against the US dollar. That's why. Okay? Uh, Okay, perfect. So I was just mentioning something about the gold. The gold, let's say if you want to talk about the gold against the dollar, it's written as XAU. This is a convention name of the gold. If you remember back in school when we studied chemistry, that table in chemistry, XAU is gold, XAG is silver. So since then we kept those conventions, and this is why it's XAU is the gold against the US, XAG is the silver against the US dollar. Okay? Now, another term that we need to learn about, team, since now we know how to read a currency pair, okay? And I just want to make sure that I can get a pen so that I can start giving an example. It's just not drawing. Okay. Okay, there you go. There you go. So if you guys have the platform in front of you, and if I want to go for an example, I'll give you an example in a second. Let me just go back to the presentation so that I tell you what the spread is, and then I'll jump straight into the example. So a spread is another term you need to learn in Forex, okay? So what is a spread? Okay, leverage, keep leverage on the side. We're going to come back to this in a second. We're going to talk now about a spread. A spread in Forex is basically the difference in two prices. What do I mean? Now, I don't think I can show you the sheet right now, but if you guys are going, I'll go back to the example. If you guys are going to Europe, to Paris, and you want to exchange from pounds to euros, you go to the exchange house and you see on the screen there are always two prices in there, right? You always see the bid and the ask price. So basically one is the price, one is higher and one is lower. The difference between those two prices is called the spread. So when you want to buy, the exchange house would give you, if you are buying, let's say if you are buying euros, of course he will give you at the higher price because he wants to make profit. If you are selling, he will give you at a lower price for him to make profit. So you always see two prices on the screen of an exchange window. Just imagine CFI as a brokerage firm. When you want to buy and sell, you always see two prices. One is the bid, one is the ask. One is higher, one is lower. The difference between them is called the spread. Okay? In currencies, the spread is usually, I will just explain in a second what the spread is. As I said, it's the change between the bid and ask. But as I want to materialize and see it in numbers. Okay? Let's see here in an example. Okay, there you go. So the spread is that, as you can see in the screen, I'm going to give you an example here. This is taken from the platform, but forget about the platform at the moment. Just think about the screen of an exchange house where you see two prices. The higher price is usually the price if you are buying that currency, and the lower price is if you are selling. Okay? The difference between them is called the spread. In currencies, it's the fourth. Usually the spread is, as let's say here, usually it's the fourth difference, the fourth point after the decimal, or the fourth number after the decimal. Okay? The change in them is the spread. The how much is the difference between the buy and sell. This is the spread. However, the fourth decimal point is called, the fourth number after the decimal point is called the pip. You guys, here in the market, the euro moved 10 pips, the Dow Jones moved 10 pips, I lost 10 points. These are terms that you also use. The spread, when you understand the spread, you also understand what the pip is. In this case, the bid side is where the market wants to buy, and the ask price is where the market wants to sell. Exactly. This is what we were saying, Richard. Thank you for the clarification. So basically, when you want to, he's just talking about where to buy at the ask price or at the offer price, and where to sell. Okay, so the spread is the difference between those two prices, the ask and the bid. However, what is the pip value is the fourth number after the decimal point. So basically, the spread is the profit that this exchange house takes. But to materialize this value that the exchange house takes, we are translating it to a number. That's why now I'm calling it a pip. So a pip value, or a point in percentage. That's the point in percentage, the fourth number after the decimal point. As you can see in this example, the euro against the dollar, it's 1.2. These are old numbers, of course. Now the euro is much less. Is 1.2293 against 1.2295. The fourth number after the decimal, if you can see, is 3 and 5. So that's 2 pips change. Okay? 2 pips. It means, I will show you later what the pip means in dollar value. But in this example, it means the change between the ask and the bid price is 2 points. Okay? So the exchange house or the broker will take this 2 points as his profit. Okay? Yes. It's only for currencies, major currencies. However, for the Japanese yen, Firas, it's the second digit after the decimal point. Same for the gold and the oil. I will talk about this in a minute. But basically, all major currencies, it's the fourth number after the decimal point. Crosses is also the second. Okay, so second after the decimal in crosses, the ones that do not involve dollar in them. Gold and oil, it's the second digit after the decimal, and same for the yen, it's the second digit after the decimal. Perfect. Okay, Firas. But for the reason of giving an example, I will stick to the major currencies at the moment. Okay, if we have time, maybe we move on to talk a little bit more about gold and oil. I will just mention them briefly. But in currency, major currency pairs, it's the fourth number after the decimal point. So as you can see, when you later on, when we will check the MetaTrader, I will see if we can do that now. I don't think we can share our desktop at the moment. Maybe next time we will. I will show you how the platform is consists, like where do you see the market, where do you see the symbols, where do you see the pairs, where do you see the stocks, and this is actually the window that pops up when you want to buy and sell. As you can see, there is always two prices, as I told you, because one is the bid, one is the ask, and the difference between them is a spread measured in pips. Okay, got me, guys? These are the major key terms in trading, in the market, in online trading. Okay. So I'll move on. As you can see, the fourth, keep it in mind, the fourth number after the decimal is your pip value. However, in Japanese yen, it's the second after the decimal, okay, when it comes to currencies. Okay? Okay, moving on. Okay. Sorry, it's not moving for some reason. Okay, 1 second. Okay, moving on. So can you guys see the pip calculation in front of you now? Okay, let me go let me talk briefly about just a sum up of what I have mentioned earlier. Okay, perfect, Firas. Thank you for the clarification. So basically, we were talking at the moment, for whoever joined right now, we're talking about online trading and what are the advantages of online trading. Okay, we talked about the Forex market and also how to trade in the Forex market and how to read a currency pair. Okay, currencies, they work in pair. You buy the major, you sell the counter or the quote currency, and vice versa. You sell the major, it means you're buying the counter or quote currency. Okay, so currencies, they work in pairs. You can also take advantage of the market going up or market going down. You can bet on the prices going up. If the euro, you're expecting it, or the pound or the Canadian, then you buy that currency against the other. If you think that the currency will go down, then you sell or you go short. So you buy, you go long, you sell, you go short. These are some terms in trading. We talked about the difference between the prices. You always see two prices on the window there because one is your ask, one is your bid price. One is usually higher than the other because it depends. If you're buying, you buy on the high. If you're selling, you sell on the low. So the difference between those two, the two prices that you see in front of you, is called the spread. Okay, and the spread is actually the profit that the exchange house or the company take. A lot of people, they'd ask us, okay, what's in it for you? We actually, our profit is from that spread, the change in buying and selling prices. And then we talked about the pip to go even deeper. After we said the spread is the change between ask and the bid minus the ask minus the bid price. Now we're talking about how to calculate that pip value. In major currencies, the pip is the fourth number after the decimal point, as you can see in the example. Now, we always hear that the market goes up 10 pips, go down. We need to know what the pip is, how to calculate that pip value. Okay, Muhammad, let's see. For the euro, these are old examples. Of course, the price now changed. We're talking about the fourth number after the decimal point, okay? Let's go for, before I go into a pip calculation in this slide, I want you guys to know something that differentiates the platform that we use from others, okay? This platform has characteristics. The platform that you use, the MetaTrader 5, has characteristics, which is 90% of investors around the world use this platform, okay? It's one of the easy, user-friendly and a straightforward platform where you can use it for doing your own analysis on it, and you can use it for your diversifying. Also, you can have stocks in there and many others in this platform. When I say stocks, I mean CFD on stocks. We can also go into details on some session on how to trade a CFD on stocks on this platform as well. Okay. Then one of the characteristics of this MetaTrader 5 platform that hopefully we can apply and see it next time in our upcoming session. You guys just tell me when you would like to have an upcoming session, or we stick to Fridays. This time we can do a continuation next Friday for an advanced session, an application session. So this platform has characteristics. The first characteristics is the size of the contract that you're trading, okay? Besides the symbols and the currencies and the commodities and all the financial instruments that are present in that platform, these work based on a contract size. So the contract size in this platform are basically three main contract sizes. From them, you get to like extinguish other different contracts. The main contract in this platform is called one lot or one standard lot. When you are buying one standard lot or a volume equal to one of any currency pair, it means you are buying 100,000 units, okay? It means you are buying or selling 100,000 units. What does that mean? Now, you might ask me, Firas, does this mean that I need to have $100,000 in my bank account to buy one lot of euro against dollar? That would be a question. I would tell you no. That's where a leverage comes in. That's the other main component of online trading, is that it deals with leverage. Leverage products, I will also explain this in a second, but I was trying to get into the pip calculation, but I felt like it's better to explain first the contract size, the leverage, and then I go into calculating the pip value and what is it, the dollar amount that you want to calculate as your profit and loss. So what I said at the moment, I'll just recap. I want to buy one lot, standard lot or contract of a euro against the dollar. That means I'm buying 100,000 units. In this case, my unit is defined as the euro because I'm buying euro against the dollar. Okay? Please stop me if you guys have any questions. So I'm buying at the moment 100,000 euros against the dollar. How much do I need to have in my bank account to control this one standard lot? That's the question I need to ask. If one standard lot is equal to 100,000 units, then this is the standard lot. Then if I'm talking about a mini lot, a 0.1, how would this be equal to? If 1 is equal to 100, then a 0.1 would be equal to input. Yes, 10,000. Thank you. Perfect. You guys, you don't even need the platform. Thank you. Yes, Muhammad. One lot is 100,000 units. Exactly. So if I'm buying 0.1 lot, Muhammad, if I'm buying 0.1 lot, this is equal to 10,000 units. If I'm buying 0.01, this is equal to 1,000 units. Okay? Perfect. These are the three main contract size. How small can you go? Is the silver lot equal? No, the silver lot is not equal to 100. It's equal to 5,000. We'll talk about this if you want in a second. It's here in the table. Well, you will see that the silver is not actually like the gold. So there you go. The gold, team, these are the standard. This is the lot that we were just talking about. In currencies, one standard lot is equal to 100,000 units. In gold, it's equal to 100 ounce. One in gold is 100 ounce. One in silver is 5,000 ounce. With me, team? Danny, 0.1 is 10% of the contract size. Yes, absolutely. Okay? And then, if we're talking about, superb, thank you. You're welcome. Sure, here to help you guys. So just look at this table, guys. Look at this table. Not the one down. Look at the table up, okay? I want you to look at the contract size. In currencies, one standard lot is 100,000 units, as you can see. For the mini lot, that's a 0.1 where you can specify it. That's a 10,000 units in currencies and 1,000 units if you're going for a micro lot, 0.01. This is the lowest you can go, but it depends on the entity and on the platform. With some entities, they do not go for 0.01. The minimum is a mini lot. So it depends on the brokerage, it depends on the entity, it depends on many factors, okay? As for the gold, as you can see, the one standard lot of gold is 100 ounce. This means that a mini lot is 10 ounce and a micro lot is 1 ounce. Okay? For the silver, the one standard lot is 5,000 ounce. For the mini is 500 and for the micro is 50. These lots were based on US future contracts as traded in Chicago and New York. Thank you, Richard. This is also specific to the platform because many other platforms, they also have different volume or different unit to measure. But basically in this platform, of course, taken from US future contracts, as Richard has specified, thank you for the information, they are taken from these sources. They have these as basics. But after all, also team, you can always open 2 standard lots, 0.2 mini lots, 0.05 micro lots. So it depends on the volume. You can always change the number. These are numbers you set in the platform. Hopefully we can see them next time. Our next session, I'm telling you from now, team, it will be application. This session is an intro. Next session will be an application. I'll open the report that you receive and we can start applying on the platform. Okay? So these are basically the contract size. Oil, one standard lot of oil is 1,000 barrels. It's measured in barrels, okay? So basically the mini lot is 100 barrels, which is 0.1, and then the micro is 10 barrels, okay? So these, first of all, we defined our contract size. After we define our contract size, we want to see what are we going to buy and sell. We thought at first in our example that we are buying one standard lot of euro against the dollar, right? Okay. For some reason I cannot. Okay, 1 second. Need to refresh. Okay, can you guys still hear me? Because it's just loading and I'm not being able to navigate between the pages. Can you guys still hear me? Okay, perfect. Mustafa, yeah, tell me, can you hear me? You're typing. Okay. Okay, team. Let me go in. Okay, perfect. Thank you so much, Muhammad. Okay, so I wanted this slide. It's taking forever for it to load. I'm sorry for that. Okay, there you go. Okay. Okay, thank you, Nadine. Thank you, Danny. Thank you, Hassan. Perfect. I'll go back to this slide where we talked about the contract size, and now I want to see what I want to buy and sell. Now, before I go forward with the example, team, I will go back to defining margin and leverage. But for you to be systematic in your head, let me take it a step by step. Okay. So in order for me to buy one standard lot, one lot of euro, I'm buying 100,000 units, right? I'm buying 100,000 units at the moment. Okay. Now, how much do I have to have in my bank account to control this contract? This is where leverage comes in. So leverage, increasing your purchasing power. This is what leverage is. It increases your purchasing power, okay? So if this leverage is usually decided between you and your brokerage firm, in our entities, we have different leverages that we provide. Some entities we provide 1 to 30, others 1 to 50, 1 to 100. This is basically tailored to every entity because in each entity we're regulated based on that country where we are obliged to offer certain leverages rather than others. So let's say today, I'm going to go back to the example. I have $10,000. I want to start trading online with $10,000 in my account. I decided with my company that I want a leverage of 1 to 30. This means that for every dollar I'm investing, I am getting 30 times power over that dollar. So it's just, you're welcome. So it's just a purchasing power. So I'm buying more. If I want to control one standard lot, that's $100,000. I don't have to have $100,000 in my bank account. What I can have in my bank account at the moment to control this is written in this example. Example 2, if you guys can see in front of you. If I want to trade 100,000, let's say I decided to open €1 contract, €1 against dollar, one standard lot, or 100,000 units. There comes a leverage of 1 to 30 that I decided to take from my brokerage. What does that mean? 1 to 30, it means 3%. Okay? So basically, 100,000 times this 3% is my margin. Okay? There goes another term that we have to know, the margin. The margin is the amount that I need in my bank account at the moment to control whatever position I'm opening. In this example, to control 100,000 units or 100,000 euros or one standard lot, I need 3% margin. 3% from 100,000 is actually $3,333. So I need to have in my margin, the margin should be 3,300. What is a margin in this case? Margin is the amount locked on the side for you to control 100,000 units, for you to control that standard lot. Okay? So basically, I'm starting with a balance of X amount. I don't know what my balance is at the moment. Let's say it's $10,000. My balance is $10,000. I decided to open one standard lot of euro against the dollar. One standard lot, it means 100,000 units. So automatically, when I do this, when I execute this operation on the platform, I see a margin locked for me or taken from my balance, which is 3,300. That's not taken as in, it is deducted from your balance. However, it's like an insurance against controlling one big standard lot in the market. As long as the position is open, the margin is locked at 3,333 in a 1 to 30 leverage. Please ask me if you guys, because this is the basic of, this is it. That's the toughest thing that I'm going to be saying in my whole session. That's actually the bulk of the presentation now. This is what I want you to get. If you don't get this, I can spend the next half an hour explaining this in more details, and I'll give you more examples. Okay? What if the loss goes more than 3,000? Let me tell you. This is your margin, Firas. Your margin is insurance or locked against the amount that you're trading. So basically, if I wish I'm not being able to write, but what I'm trying to say, let me go to the board, to the whiteboard, okay? I'm controlling one lot or 100,000 units of, I'm controlling 100,000 units of a currency pair, okay? That's so bad, sorry. 100, it's not gonna be easy to draw here. I don't have a mouse. I'm using the key. Anyways, so I want to control this one lot or this standard lot, okay? If you go to the platform, you see something called balance. The balance is the amount that I start with. The balance in this case is 10,000. Let's say today I started with $10,000 in my bank account, okay? $10,000. I decided to open one lot of euro against dollar, of a euro-dollar pair. Euro against the dollar, okay? I'll just go for the sign for it to be faster. Okay, so this is my balance. Once I open one lot in the market, automatically I find my margin here going to be, I'll call it M. My margin locked is going to be and 333, but I'll keep it as 3,300 for the sake of calculation. So this margin, Firas, is locked for me to control this one lot. Therefore, my free margin in this case, what is my free margin equal to? My free margin is equal to the $10,000 minus my margin. So that would be how much? 0, 0, 6, and 6,700, something like that, 7, 8, 9, something like that. $6,700 is my free margin. What does this mean, Firas? It means that the euro can move up and down as much as it wants. I am safe as long as my free margin here is still moving. This is the amount that can tolerate the movement of the market. The margin does not move. The margin is locked. If, to go back to your example, if for one reason or another you lost all your free margin, okay, that would be your margin right now is equal to 100% of your equity. Here you have the equity. The equity is usually, your equity is usually your margin plus your free margin, okay? This is your margin plus your free margin. This is your equity, margin plus free margin, okay? I will not write it here, but at the moment, the equity moves with the free margin movement. So this is a variable number here. It moves with the free margin movement. If for one reason you lost all your 6,700, okay, because you have a lot of lots open and the movement was so hard, so high. Now I'll tell you exactly how to calculate the point and what the movement was. But let's say you lost all your 6,700. The margin is still in your account. At the moment, your equity, your free margin is 0, and then your equity is equal to your margin. In this case, you have 100%. At this point, usually you decide with your broker if at 100% you want to open an opposite account, a counter position. Let's say if you're buying, we open in front of it a counter position because you don't want to lose. You go for 100%. That's called, I don't want to talk in this more details when I go for application, but you can get a margin call on 100% level when the equity is equal to the free margin. When it's 100%, okay, you get a margin call. You can decide with your brokerage firm that I want you guys to take from the free margin up to, let's say, 50%. So when you have 1,500 or 1,600, you get a margin call. That would be 50%. Okay, you got me? So zero or liquidation we don't usually have. For you to lose all this, we usually try not to go this extra mile, but it can happen. But usually 20% is like, you can always have 20% in your free margin, in your margin account that will always keep. So I can trade with the free. You can trade with the free margin, absolutely. The margin is locked, okay? But if your free margin goes to 0, if your free margin for some reason goes to 0, it means your equity is equal to your margin. That's called 100%. There you get a margin call because you have 100% at the moment, your margin and equity. We open an opposite trade. If you have a buy, we open a sell in order to hedge your position so that you do not lose your margin. Your margin will protect you. That's the main reason for a margin, is to protect you. It's your insurance, okay? Okay, got it, perfect. Let me go back to the presentation now. I know I have a very bad handwriting, sorry for that. It's just, I don't have a mouse, I'm writing with the keyboard. Okay, let's go back to the presentation. The margin percentage is determined by dividing, let's go back to the example if I can see, okay. The margin level where you see it on the platform, Hussam, hopefully next time we will see it clearly on the platform. Usually it's in a percentage form, okay? I call this as your safe protection level or safety level. As long as it's above 100%, it means the equity from the margin is above 100%, you are safe. Okay, so it's basically your margin against your equity. How does leverage behave if you are winning? How does leverage behave? Do you earn the example 30 times more? Yes, yes, but let me Solvag, sorry, I can't I'll go back to your question, but let me just finish with Hussam. So your margin level in this case is your protection level. As long as it's above 100%, you are safe. The margin level is basically your equity and your free margin. Okay, so it's your margin over your equity. It's a division, and it's in a percentage form. As long as it's above 100%, your account is safe. Okay, that's what you need to know. We will see this we will see this next time, hopefully in a live example. Team, I want to go back to the presentation. When you do your profits, when you make your profit, so that this is where your leverage comes in. Just 1 second. I'm trying to get into the presentation. Okay, finish whiteboard. Okay, I can't go back to the presentation for some reason. I'll just give it a second. I think it will switch automatically in just a couple of seconds. Yeah, go ahead, Hassam, ask me. So that I didn't forget you. I'll come back to you. I will just want the presentation to open so that you can see clearly in front of you. Of course, yes, Hussam. It magnifies your profits as well as it magnifies your losses. Of course, online trading has this benefit of multiplying your profit, but it also multiplies your losses. That's why, team, 1 to 30, you need to know that 1 to 30 leverage is for your advantage. When we lock 3,300 in the margin, this is for your advantage. This protects you, okay? Yeah, I'm sorry, I just can't go back to the presentation. Anyways, so let me I'll just refresh, team, 1 second. I'll refresh and come back. Okay. Thank you, Danny. Why did you... Okay, I'm back, guys, and the presentation is back. Can you hear me? You're asking me what does it mean? Okay. Okay, Danny, let me tell you. We usually send those as alerts for people that you need to know something. Over the weekend, especially in these times that we are going through right now, they're not usual times, to be honest. And these times, you tend to have high volatility in the market. When you have high volatility in the market, you sometimes wake up in the morning and find that the market opened on a gap, okay? Eli, I recorded this session. I can send it to you later on as a basics, because to be honest, team, next session will be application. So I want you to go over this session. Yes, I will send it to you. I have hopefully I can send it to you because I want you to go over this. So next time you come, we just go for application. Okay. So basically, Danny, sure, Eli. But Danny, is what I wanted to tell you is over the weekend, sometimes Friday closing, Monday you open up with a huge gap. Okay, so we always ask our clients to, thanks Rami, so we always ask our clients to make sure their margin level is above 100%, or they close all their positions before the weekend, because if the market opens on Monday and the margin level drops below 100%, you get a margin call and we can't control it because of the gap. Just like what happened to the oil prices. Oil prices all of a sudden dropped more than 10 points. So what happened is people all of a sudden started leaving the market because the free margin went to zero, and then they had to open their margin because it happened all when the market was closed overnight or over the weekend. So it opened on the cap, and a lot of small investors that didn't maintain a margin level above 100%, or they didn't close their positions over the weekend, they were actually liquidated from the market, or they left. That's why, for your own benefit and for your own sake, we always ask you to either close your positions and make sure you maintain 100% margin level over the weekend. Hussam, what do you mean the money of the leverage belongs to CFI? I wanted to, please. Yes, Fernando, I will send it. Sure. Thank you. Okay, guys. So I'm going to give you another example so that you understand, because I want you guys to understand what we're talking about. Let's take another example for leverage of 1 to 100. Other entities, they provide leverage of 1 to 100, but this is always, it's a decision. It depends on the regulation and the country and what have you. Okay, so let's say you have, I'm going to go back to the example of $10,000, and you have a leverage of 1 to 100. A leverage of 1 to 100 means you have a margin, or 1 to 100, a simple calculation. Okay, perfect, Muhammad. Tell me, where can I'm gonna go another example for you to understand. Yes, Muhammad, this is the toughest thing you're gonna learn. This is it. That's how the market works. If you get this, then you got the hang of it. Okay, everything else works in exactly the same mechanism. So I will give you another example now, and if you still don't get it, please let me know. Okay, so I'll give you another example. Let's say today you decided to open an account. Okay, you decided to open an online trading account, and Muhammad, what's the amount? Let's say you want to start with $5,000 or $10,000. I'm gonna take for as an example $10,000. We'll stick to the same example so that I don't vary a lot. The first thing you do, Muhammad, with your brokerage firm is you guys make sure that you agree on the leverage. Okay, this is the leverage. The leverage, as I has explained earlier, it increases your purchasing power. So for every $1 you invest, the company is giving you a purchasing power of 100 times this dollar. Okay, so basically with $10,000 you can control 1 million in the market. Okay, if the leverage is 1 to 30, with $10,000 you can control $300,000 in the market. Okay, go back to the example of one standard lot. One standard lot is 100,000 units. You don't have to have $100,000 in your bank account to control this standard. If the margin or the leverage is 1 to 30, then you can basically control $300,000, which, if you think about it, you can almost control with $10,000 3 standard contracts. Okay, I'll come to your example, Hassam, in a second. I'll just finish my my sentence so that you guys can understand. Okay, yeah. So basically, in my $10,000, if I will keep the same balance, I will go over the 3 different leverages to know your calculations. I start with a balance of $10,000. I agreed with my broker that my leverage is 1 to 30. It means technically I can control $300,000 in the market. Remember, one standard lot is equal to how much? 100,000, right? So in this, trader 1 can control 3 standard lots. 3 standard lots will be almost $9,000 as a margin to control, because you have this purchasing power. However, this would be very risky if you open 3 contracts, 3 lots with a balance of 10,000. Very risky. The reason being, the example in my whiteboard that I just showed you, you need to keep in mind that your margin should not exceed 25 to 30% of your balance. Okay, that means if I want to open in this example 1 to 30, 10,000, I'm opening one standard lot of euro against dollars. It means I'm controlling example 2. As you can see, I'm back on example 2. To control 100,000 lots of the euro against the dollar, I want 3% margin. That is the 1 to 30 leverage that the company gave me. So the margin locked is 3,300. This is the insurance that's making me control that 100,000. You see? So 3,000 is how much from your balance? You started with 10,000. 3,000 to control this lot. 3,000 at the moment is 30% of your 10,000, right? This is more, you stop here. You stop here. You keep $6,000 to $7,000 in your free margin to control the movement of the market. This is how you keep yourself in the market. You stay protected when you only use 25 to 30% as your margin, as you can see in the example, from your balance. This was the margin level, Hussam, you asked me earlier, or you asked me earlier about the margin level. The margin level in percentage, okay, should always be above 100%. In this case, the 3% from the 100,000 is $3,000. Please ask me if you didn't understand. Locked margin is 3,000. Free margin is 7,000 or 6,700. This at this point, I prefer that you do not open more lots because you will be at risk of losing all your free margin. However, you can always go for 0.1 lot. You don't have to open one standard. You can open a micro or a mini 0.1. So this way, to control 10,000 team, if you want to open 0.1, not 1, so it means you're opening 10,000. To control 10,000, how much is the margin? How should margin should be? 3% of 10,000 is actually, yes, Danny, you tell me. Exactly. With $330. Thank you, Firas. Perfect. With $330, you can control a mini lot. I don't have to go to one standard. I can go for a mini lot. That's a 0.1. I'm controlling 10,000. However, in a mini lot, the movement is, of course, less risky. My returns are less, but my losses are also less. In one lot, my returns are higher, but my losses are also higher. So it's just a balance, okay? So that's my point. If you want to open with 10,000, you can open up to 30%. When I say 30%, that's your margin of your balance, okay? 30%. So if I'm starting with if I'm starting with $50,000 now, I can easily open 2-3 standard lots. I can easily open 3 standard lots. This way, every standard lot, I have a margin of 3,300 locked. So 3 standard lots, I have almost 10,000 locked on the side. I still have 40,000. I'm safe. I'm almost on 20% margin from my capital, from my investment, from my balance. So I'm safe, okay? That's what you need to keep in your head. Try to keep your free margin bulky, because this is the one that will protect you against the price movements. Okay, guys, did you get this? Can I move? I want to talk about one more thing today. I want to go back to the gap issue. Okay, Danny, tell me. Just okay. Tell me, Danny. The gap issue. What I wanted to tell you is, if the price closed on Friday evening, let's say I don't know, let's talk about Brexit, for instance. I wanna talk negatively about the market, not positively. I'm gonna take the opposite scenario, okay? What if already suffered losses? How we shall close on Friday? You usually go, you have many options. It's, if you wanna keep, you can, Danny, at the end of the day, it's a choice. We are advising you, but it's a choice. You can keep your trades open, but we are advising you to, if you want to keep your trades open, make sure that your margin level is relaxed. Your margin level is more than 100%. That even if the market opens on Monday on a gap, you are still protected. If not, try to close some of your positions end of the week, or try to hedge maybe. Sometimes you hedge, you open opposite, buy, you open against it, a sell. There are many ways for, there are many ways for risk management. We can talk about this in some other sessions about risk management. So there are many ways to hedge, but either you open an opposite trade to relax your margin a bit, and then your margin level will be more than 100%, even if the market opens on a gap, you will be safe, or you close some positions. Okay, so what if already we can manage it by setting stop? Of course, this is another way to manage your account. Stop loss and take profit on the platform is very important. When we actually do a trade that we will go over this next time, you always put stop loss and take profit. One of two important things that I just mentioned: your margin should not be more than 25 to 30% to stay in the market with this volatility, please, of your capital. And second of all, thank you, Danny, for reminding us, or thank you, Muayyad. You always need to manage your account by putting a stop loss and take profit. But this, we will talk about this in depth later. But these are two key elements in the market, okay? I just want you today to understand the mechanism of how the leverage, margin, what is the PIP, how to calculate these small details are very important before we start actually implementing our trades. Okay, so as I have mentioned, team, if you why example 1 has a margin of 1% and example 2 has a margin of 3%? Good question, Hassam. Because in example 1, you are as trader C. You decided with your company to go for a leverage of 1 to 100. Therefore, the 1 to 100, it means 1 divided by 100, which is basically 1%. This is your margin. So in this example, the margin is 1%. So from $5,000, if you want to open, you know what $500,000 is, Hussam, at the moment? How many standard lots is a $500,000? Exactly. Thank you very much. Well done, Hussam. So 5 standard lots, if I have a leverage of 1 to 100, that means a margin of 1%, because 1 divided by 100 is 1%. So from a 500,000 times 1%, that's a 5,000. This is your margin. This is your margin on the side. So you need $5,000 to control 500,000 units, okay, in the market. So this is why 1% is associated to 1 to 100, 3% is associated to 1 to 30. Okay, got it, Hussam? Perfect. Okay, so I'll move on, team. I'm really sorry. I wanted to do an application today, but it seems like we're not going to be able, because I cannot share my desktop at the moment because of some technical issues. Best briefly, I'm going to go over. Sure, here's my email. Yeah, it would be a very good idea for you guys to send me cfidubai.com. If you guys can send me reminders, or also if probably I'll just double check. I'll get you in contact with our colleagues from the UK as well, Danny. But if you have any questions, please feel free to send me an email, and I will definitely share the presentation with you guys. I wanted to ask you actually, Hussam. I mean, to be honest, at the moment we set once a week every Friday. But if you guys feel like we want some practice, maybe we can have a practical session during the week, so we can apply the platform. Yeah, maybe we can apply the report on the platform, an actual application. Okay, so I will set one session as theory, which is on Friday, and then another session as application. Okay, but the week after we will go for more theory sessions. Okay, but yeah, but yes, exactly, this is what it will be during. Okay, perfect. Okay, great, guys. So I think maybe during the week, maybe on Tuesday or Wednesday, we go for a practical session. Tuesday. Okay, perfect. Tuesday is great. Yes, you need to sign up, Hassam, for every session. Hassam, at the moment when you went into the session, you definitely put your email. So next time when I'm sending a new invite, you will receive it by email, okay, to enter the session. So you will get an email, and then if maybe later on we will exchange numbers, and this way I can also send it by WhatsApp. You guys can always access this session over, if you download your Click Meeting application, it's an app, you can always access this session through a room ID. Anyway, so basically we will okay, Hassan. And now, to be honest, when you went in this session, I think I have your numbers, so I will create a group with the numbers with the people that entered the session. Okay, I will create a group. I will. To be honest, I will share my number, because if I want to create a group or a broadcast, you guys need to save my number so that you receive the session or the coming up sessions. So I will share my number if okay, 9715543145330. Okay, guys, I'd rather that you guys just save my number, because when I add you on a group, I need to have the number so that when I broadcast, you guys receive it. If you don't save the number, you will never receive anything. Okay? Okay. So once we finish this session, I'll download it and send it to you, and then next week or Tuesday we will have the application session. Okay, just brief before I just sum up. Team, as someone mentioned about the fourth decimal point in currencies, as I told you, in yen it's the second, as well as in gold and in oil is the second point after the decimal. Okay, now team, we didn't talk about the pip calculation. I want to talk about the pip calculation before I close this session. Okay, pip calculation is very, very important for you to know how to calculate your profits and losses. Okay, so we identified, I'm going to go back to the example to see how we calculate the pip. This way we can close the session. I'll go over a summary fast before we close the session. So to calculate the pip, team, what is the pip? The pip, as we all know now, is the fourth decimal point, or it's the fourth number after the decimal point in currency pairs, right? Okay, how to calculate the pip? Now, let's say, to be honest, I'd rather go to a whiteboard here. I'd rather go to a whiteboard. It will be, let's erase this. Image, text, erase. Okay, how can I erase? Seriously, that's not how I want to erase. I want it bigger. Okay. Anyways, it's kind of tricky without. Thank you, Muhammad, for laughing. Okay, yeah, just adding some fun here. Okay, guys. So just want to go over the pip calculation. So for currencies, team, we said that a pip for currencies is actually the fourth decimal point after the fourth number after the decimal point, right? So in terms of, wow, can you guys see a text? 0 point, oh my god, connection problem. He lost me. I'm back. Can you guys hear me? Okay, I'm back. Can you guys hear me, see me? Okay, I'm sorry for that. Just some network issues. Okay, perfect. Pip calculation, fourth decimal point, fourth number after the decimal point. So if we want to write it down, that would be, if I want to write it down, okay, 0.0001. Isn't it the fourth decimal point, if the fourth number after the decimal point? So it's 0.0001, right? That's your pip. That's the pip. It's the fourth number after the decimal point. What you can do, guys, is you can take this number and multiply it by the contract size. So just for us to be clear on something, in order to calculate your pip value, which is the smallest measure units, you have to define three main things. First of all, the pair that you're working in. Can you hear, guys? Oh, you guys cannot hear me. Can you hear me? Okay. Okay, perfect. Muhammad, can you hear me? Okay, Fernando, great. Hear and see. Perfect. Thank you, Richard. I don't know, maybe, Muhammad, if you can restart your session. If you can't hear us, Muhammad, please restart your session. Uh, I'm talking to him as if he can hear me. Please restart your session. Okay, guys. Let me finish this fast. So the pip, as we said, is 0.001. Okay, and you need to identify your value. The pip is the smallest measure unit. To identify your value, you need to go three. You need to know three main things in the pip for you to calculate its value. First of all, you need to know which currencies are you working on. Are you working on major currencies? Are you working on the fourth decimal point? Are you working on a Japanese yen, which is 0.01? Are you working on gold? So you need to identify your instrument first, okay? After you identify your instruments, you identify the lot size. Am I on a 1 standard? Am I on a mini? Am I on 2 standards? So you multiply this by your lot size, okay? So in this case, I'm multiplying it by 100,000. That's my lot size, okay? And then what you need to know is what you do now is you multiply it by your exchange rate. Like the euro is 1.0 blah blah blah. So in order to get the exact number, now for the purpose of calculating, I will not go for the exchange rate. I will make it as $100,000 as I'm purchasing one euro against the dollar. Let's not go for the exact euro change. But what you actually do is you multiply your contract size by the pip value. In this case, 0.0001 times 100,000 is equal to, what you do, guys, let me tell you what you do. You move the point, how many? Exactly, thank you, Firas. You move your point 1, 2, 3, 4, 5, because you have 5 zeros. So you move your point 5 units, and then you get $10. That's how you calculate your pip for a standard lot. If it's $10 for one standard, then for a mini, it's gonna be 10,000 and not 100,000. So that would be $1, right, Mustafa? Right, Danny? Right, Firas? Right, you guys got this one? You guys just got the pip calculation? Perfect. Okay, perfect. So for a mini contract, that's a $10,000, not 100,000. We get $1. Perfect. Perfect. Thank you, Danny. Thank you, Firas. Okay. And for a micro, that would be 10 cents. Okay. So back to the presentation and back to the example. This was the pip, the 100,000, the one contract size. The fourth decimal number, the fourth decimal after the point. This one is okay. So it's $10 for a big contract. So how can I calculate it for Dow Jones? We will talk about this, Mustafa, in terms. We will talk this more about in details in our next session. Okay. So we will talk about oil, gold, and Dow Jones in details. We can also apply them. We can also apply them on Tuesday. On Tuesday, we. Why? You don't want to trade the Dow Jones? Don't worry, guys. We will talk about this more in details on Tuesday. Risky, yeah. Yeah, it is risky. It is risky. Right. Yeah, you can buy, you can sell. Well, so tell me, are you guys receiving our reports on a daily basis? Yeah, better. Like if you want to start small, maybe stay away from the risky instruments, but later on. Okay, perfect, Hassam. Any questions about this? Just a brief or a quick like application on the final pip calculation value. If the euro moves from 1.0, let's say the value of the euro today is how much right now? I'll check the price. Let's say it's 1.0111. It changed from 1.0111 to 1.0112. That's a 1 pip up. So that's a $10 if in case you have a standard lot. That's a $10 profit for you. Okay? That's how you calculate your profits and loss. Similarly, if it went down 1 point, that's 1 pip, that's a $10 loss on a standard contract. Okay? So guys, we meet on Tuesday, hopefully. Tuesday, maybe same time, would at 1 or at 2 or same time. We'll keep it at same time. Same time. Okay. So Tuesday, perfect. Tuesday at 1, we will meet for another session, which is gonna be the platform. I hope the same group comes in so that we go over the platform very fast. I'll explain to you how you can take maximum advantage of the platform, how to read the chart briefly, and we will do applications on everything. One on the currency, one on the gold, one on the oil, and one on the Dow Jones. And one on the stocks, Mustafa, if you want, only for you. Okay? Perfect. Perfect, Danny. I'm glad you guys, I mean, hopefully we will be having more sessions along the way. And yeah, so goodbye for now. And hopefully we will meet on Tuesday. So please save my number and I will. Thank you, Hassam. Thank you. All what I want is to give you as much as I can information. Yeah, it's interesting. No, I mean, I'm energetic because it's interesting. Then a full course. Yeah, see, wow, that's nice. That's a nice compliment. Thank you, Fernando. I'm glad you did. I'm glad you did. I tried to make it simple because it's really simple. I mean, some people make it a lot more complicated, but it's just so simple. You're welcome, guys. Okay, we'll meet on Tuesday then. Please save my number. I will send you the reminders to meet on Tuesday by WhatsApp, and hopefully I'll send you the record as well. Thank you, Hassan. Okay, bye guys. Have a good evening. Okay. Bye, Firas. Bye. See you. Bye bye.